The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box with Karen Cho and myself, Steve Sedgwick, and these are your headlines. Well, the Fed, as expected, kept rates on hold whilst, just easing off on their growth forecasts and bumping up inflation projections. But markets look past those warning signs and cheered the prospect of potentially 2 more cuts this year, whilst Jerome Powell says the Fed is ready to respond to any risk.
Right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully.
Well, fresh from the Fed, China hits hold for the 5th straight month, whilst the Bank of England and the Riksbank are expected to follow suit, whilst the Swiss National Bank is poised to cut once again. We're going to speak to the SNB chair, that's Martin Schlegel, that'll be today.
Investment is on the cards for Nvidia, with CEO Jensen Huang setting out the firm's spending plans exclusively to CNBC.
We're building AI infrastructure for the world, and it is very clear now that we're about $150 billion of AI infrastructure into a journey of trillions of dollars of infrastructure. We've got a lot of AI to build.
US President Donald Trump says peace talks are on track after a very good phone call with his Ukrainian counterpart Volodomyr Zelenskyy. But Moscow and Kyiv still accuse each other of breaching a partial ceasefire on energy attacks.
I am really dumb. I know a lot of you think that already, but I don't understand economics at all.
Economics 101?
I thought I studied it. I thought I'd been part of my career for nearly 40 years, but I really don't get it because I thought that tariffs were good for the US consumer. That's what I've been told by the administration. I thought they were great for US growth, great for US investment. They're going to lay the foundation for tax cuts as well. But apparently, according to Truth Social, the Fed will be much better off cutting rates as US tariffs start to ease their way into the economy. Do the right thing. But hang on a second. If tariffs were so positive for the economy, surely that is less of an impetus to have easier monetary policy.
We're straight into the area of unorthodox monetary policy, haven't we? A little bit emerging market-esque. And it's funny because we had Turkey in the headlines yesterday, and the last time we were talking in a big way about unorthodox monetary policy, higher inflation, lower interest rates. It was through the lens of Turkey, and that experiment played out really well, didn't it?
Yeah, so tariffs are so good for the US economy. We all understand now they're so good for the US consumer that the Fed needs to cut rates more aggressively. It's just what we're being presented with on a daily basis. The Federal Reserve has kept its benchmark rate unchanged with the 4.25 to 4.5% band, as expected. However, it offered mixed signals over the direction of the US economy, warning of an increasingly uncertain outlook under the Trump administration, whilst still forecasting 2 more 25 basis point cuts this year. The market liked that latter point. Speaking to reporters on the back of the decision, Chair Jerome Powell said the Fed was not particularly confident in its outlook, but stressed it's in a strong position to respond to shocks.
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at a place where we can cut, or we can hold what is clearly a restrictive stance of policy.
The latest dot plot still points to 2 more 25 basis point cuts this year, with 19 FOMC members seeing rates in the 3.75 to 4% band by the end of the year. But 4 members now see no change for the rest of the year, compared to just 1 at the January meeting. And this is how US markets responded, back in the green. The Dow putting on about 0.9%, just a nod to some of the uncertainty that markets were on tenterhooks, wondering whether they could get some other shock from the Fed this time round. But the steady tone from Jay Powell carrying through to the market action. S&P 500 tracking up more than 1% and the Nasdaq firmer by 1.4%. Of course, it's been technology names that have been battered of late thanks to some of the economic uncertainty. To Treasuries and the playbook across the bond markets, this is where we are perched this morning. The 2-year just shuffling a little bit lower, so we're still off the 4% handle. The 10-year we're tracking at 4.23 this morning. To the dollar and the impact on the dollar trade. This is where we are trading today. Sterling, euro, both seeing a little bit of softness as the greenback manages to wrestle back some control. Clearly, we're watching a couple of central bank decisions today as well. Dollar yen rates also seeing just a little bit of a drift today. But don't forget, we saw the BOJ earlier in the week suggesting that the uncertainty was having some bearing on policy. And that was when we saw the drop in Japanese yen. So dollar now giving a little bit of that territory back. Dollar versus the yuan is also firmer, Steve.
So much going on. The FOMC also slashed its growth expectations for 2025 whilst bumping up its inflation forecast. Although I thought it was really important, the inflation forecast for the end of the period was still the same, pointing, though, to a potentially stagflation environment. I've seen stagflation mentioned. I personally think if we've still got growth, it's not stagflation. Stagflation is when you've got no growth. But anyway, I'll ask an expert about that in a while. It now sees GDP growing 1.7% this year with core PCE, its preferred inflation gauge, rising 2.8%. Mr. Powell was upfront about the impact of Trump's tariffs on inflation, warning they could delay the Fed's progress, but he played down potential longer-term effects.
Some of it. The answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation.
Fascinating set of data, the press conference, the SEP as well, the decision. Abby Watt is US economist at UBS Investment Bank. Is going to tell us everything, which is great. And nice to see you. First time we've met, so I know you've met Karen before, but lovely to see you. Thank you for joining us early. The open question, what did you think about it?
So what I thought was quite interesting was maybe the difference between the tone that Chair Powell struck in the press conference and the tone of the summary of economic projections. I think Chair Powell obviously acknowledged the great amount of uncertainty that the FOMC is facing. And obviously we didn't see a shift in the median dots, but you did see a shift towards tighter policy in the distribution of the dots. You know, you saw 8 dots, projecting rates of kind of just one cut this year or no cuts. Yeah. So I do think that was quite a shift relative to December. And I think the other thing that was interesting was when discussing kind of the inflation impacts, Chair Powell, pointed a lot to some of the dynamics we've seen recently potentially being driven by tariffs and the idea that, some of the forecasts could be driven by tariff risks. Whereas on the growth side, he kind of, despite the downward revisions in terms of the projections for growth, he did say that, you'd seen softness at the minute in the soft data, but that hadn't necessarily translated into the hard. And so I just think there was a little bit of a contrast between what we could take away from the summary of economic projections and the actual signaling from Powell in the press conference.
Because Karen and I speak a lot about the sentiment data versus the hard data, and that was a clear delineation. He's saying, look, the hard data is fine at the moment.
Yeah, I think we're expecting a step down in consumption in the first quarter, and I do think that's partly related to this pattern that we tend to see in the US economy, where you see a very strong Q4 followed by a relatively soft Q1. But I do think that if we look at the retail sales report that we got earlier this week, it was relatively mixed. You saw a bounce back in the kind of control group of stores, which is the stores that feed into the estimates of the national accounts for spending. And when we look at that, you've seen a bounce back, but that's from a very soft January. So you're kind of back where you were in December rather than seeing necessarily a re-acceleration. So I do think the question will be, if we see some of that sentiment data ultimately kind of feeding into both consumption and also investment. I think the other thing to acknowledge is is just this idea that if we think about kind of expectations for the Fed this year, it feels like the distribution is potentially that they deliver less easing than more. And I think we have to think about how that potentially feeds into investment decisions for firms as well.
Let me tackle sentiment from another angle. And this was from the post that we saw from Trump, effectively egging the Fed on to cut interest rates, even as they face this tariff threat that could be inflationary for the economy. What sort of message and what sort of sentiment impact does that actually have? Because it was only a few months ago we were talking about how bond markets were concerned about the extent of government spending, government debt, and that if we saw any extra pressure on top of this for the Fed to get going, any lessening of the independence, then that would be just another negative on top. And the markets might just see some sort of tipping point. For Trump to get involved at this point and call on the Fed to be cutting rates, how political is that and how unhelpful at this stage?
Look, I mean, the chair is always very careful in his communications around the implications of these.
Trump wasn't, which was the point.
Yeah, I think for the FOMC, they're going to be looking at the administration's policies. They'll say, here's what the policies that have been announced, and here's how that's going to impact growth, and here's how it's going to impact inflation, and then that ultimately feeds into their monetary policy making. I think that's the way the FOMC will be viewing that. I think the question is, just given the uncertainty we've seen in the administration's policies so far on tariffs, I think that is making it a challenging, difficult time for the FOMC in their monetary policy making, because part of the issue with the tariff policies is to actually truly understand the effect, you need to know how long they're going to be implemented for. And obviously, as we've seen so far, there's been kind of changes in tariff policies relatively quickly. And so that's a very difficult environment for the FOMC to kind of gauge the effect on the economy.
The Fed tried to keep a straight face as it was communicating a lot of the changes yesterday. And to the point around uncertainty, it specifically was talking about whether weaker growth would feed into higher unemployment, not about the uncertainty, but actually about the weaker growth line. Do you think that's possible? Because for the last number of years, we've been talking about the strength of the labour market, but even in services recently, we were seeing that at drinking establishments, Americans are pulling back.
You still call them drinking establishments,
Drinking is somewhere you go
Bars,
to pull up and you purely go
pubs.
there for the purpose of drinking. But, if the heat is coming out on the services side, even at drinking establishments, surely that unemployment rate is actually going to move, and perhaps it's going to move faster than the market had anticipated.
Yeah, so our expectation is that we do see growth slow overall this year, and part of that is tariffs, part of it is fading fiscal support as well, and I think that ultimately will lead to a move higher in the unemployment rate. We have the unemployment rate at 4.3% by the end of the year. The FOMC yesterday had 4.4%, so the expectation is that you do see some further kind of loosening in the labour market, and you see a move higher in the unemployment rate.
We've got a slate, I think, of what the president had to say. If you got that ready, can I just read that again off the screen again? Because I think it's... I've looked at economics. I'm not an economist. I've kind of been in financial markets since 1988, but I'm really dumb, Abby, and the viewers know that by now. The Fed would be much better off cutting rates as US tariffs start to transition, ease their way into the economy, do the right thing. I thought every message I've heard, we can come off there, every message I've heard from the administration is how great tariffs are for the US economy, how great they are for US companies, how great they are for the US economy, because they're going to enable us to make massive tax cuts. Why would we need more Fed rate cuts if tariffs are so good?
So I think the question on the implications of tariffs for the economy, right, is basically the gist of what you're getting at.
I'm being really sarcastic is what I'm getting at.
And I think the way that the issue is the timing of some of these things is not simultaneous, right? So the disruption from tariffs in terms of companies having to think about potentially shifting their source of imports or potentially trying to kind of, look for another way to avoid the tariff cost, that takes time. You're talking about the potential for kind of an increase in investment and domestic investment in the US, building out manufacturing capacity. That doesn't happen overnight.
Is there still a question about whether tariffs are good for the economy? I watched Ronald Reagan last night because I actually think Ronald Reagan was one of the most magnificent presidents in the United States, and I watched him. And he's done loads of speeches on this. I think it was from 1987. It was called Canada and Tariffs. Have a look at this. I want you all to look at it. It's 5 minutes long. It won't hurt you to do so. And he brilliantly laid out why tariffs are bad for America. They were bad for America in the late 18th century. They were bad for America bad for America and the rest of the world in other periods of history as well. Why would they be good now?
So in our modelling, we do find that they are demand destructive, right? We would say we've found that the economy slows in our scenarios when you see these tariffs put in place. But I do think you have to think about the breadth of what's being covered by the tariffs, the type of goods that are being covered by the tariffs, and also the kind of integration of the supply chains for the countries that you're applying the tariffs to. So I think Canada is a really good example of this, right? You have very integrated supply chains in a number of industries between America and Canada, and that's an area where, you know, the potential for the impact of tariffs is amplified because of that supply chain effect. And I think, you know, that was acknowledged with the kind of shift towards the, you know, non-USMCA compliant imports being covered with the higher tariffs for 1 month. But I think, you know, as I said, I think it depends on the constellation of tariffs that we get implemented potentially on April 2nd.
Okay, it comes to me, the question is, who do you trust on the economy, Ronnie Reagan or Donald Trump?
Right. Let me take you to some of the less noisy stuff yesterday, because I wonder whether there's something in there for risk assets. And this was around QT, quantitative tightening, because there was this move that the Fed announced that they're going to slow the ongoing drawdown of the $6.81 trillion balance sheet. This did attract dissent. So Waller decided that he wasn't going to vote for the latest policy statement because of that change in policy. What does that mean for those who are holding risk assets who have been nervous in recent weeks?
Yeah, so we saw the potential for a change in balance sheet policy at this meeting. And I think we'd kind of said going into the meeting, you know, we hadn't heard a huge amount in terms of preparation. We had seen it in the January minutes that it was discussed by the FOMC, but in talking about it and in speeches, we hadn't heard a huge amount from them. So we were a little bit kind of cautious in whether we would see that delivered. And obviously we did see kind of a tapering in the runoff. We didn't see the full stop of the runoff of Treasury. So I think that's important to note. And I think our expectation would be that we continue to see that pace kind of continue. I think it was interesting that it was still delivered yesterday, despite the idea that we didn't necessarily see the preparation of kind of the messaging around that necessarily from a number of FOMC members, though. But yeah, our expectation was that we would begin to see that kind of runoff
but what's
slowing.
The impact?
I think for the market, you know, I think potentially people are always trying to equate kind of the changes in balance sheet policy and how that then feeds into interest rate policy. And I think Chair Powell yesterday was quite careful to try and separate the two. I think, you know, if you look at kind of academic studies, they would say that the kind of rundown you've seen in the balance sheet so far would be equivalent to around 50 basis points of kind of hikes in terms of offsetting the kind of loosening there in policy. So I think that's the way that I would think about it, is just how much does this potentially offset? I think that's how markets should potentially be thinking about it too.
Super duper. Lovely to meet you. Thank you very much indeed for joining us. Nice and early. Abby Watt, who is US economist at UBS Investment Bank. And for full analysis on the Fed's latest rate decision, its forecast and its assessment of tariffs, head online to CNBC.com. And I'll tell you, please, please, please find 5 minutes of your day, especially if you are pro-tariff, and you're a Republican even. Have a look at what Ronnie Reagan said in the 80s. There's loads of videos out there. The one I was looking at was from 1987. He did a lot of public addresses, a lot of PBS readouts as well. Just listen to what Reagan said and then compare that to what Mr. Trump says about the exact same issues. Canada, the US place in the world economy, and the benefits or problems of tariffs. It is well worth 5 minutes of your time, everybody.
You went all Sabrina Carpenter there. Please, please, please. It was very 2025.
How was the concert? Was it good?
It was very good.
Okay.
A bit of modern day injected into some historical economic analysis.
Yeah, I'm less of a Sabrina, more of a Ronnie, I must be honest.
Yeah, right. Well, let's push on to China. The central bank has kept lending rates unchanged for the fifth straight month, in line with expectations. The country's one-year loan prime rate sits at 3.1%. While the 5-year rate is 50 pips higher. It comes after Beijing rolled out further stimulus measures this week aimed at boosting consumption. It is a bumper central bank day in Europe. The SNB is expected to cut rates by 25 basis points amid easing inflation, while the Riksbank and Bank of England are expected to keep rates on hold.
Coming up on the show, Nvidia pledges to spend hundreds of billions of dollars on scaling up its US supply chain. We'll have more on this after the break. Plus, the Turkish lira stumbles to record lows as one of Erdogan's main rivals is arrested days before being named as a presidential candidate. I'll bring you all the details later this hour. And earnings season continues here on CNBC. We'll be joined by the chair of Lloyd's of London. That's Bruce Carnegie-Brown. Don't miss that interview, 700 GMT. Ladies and gentlemen, here's a public announcement. A British summer is today. It may only last today, but we are expecting British summer today. So if you want to get out and get ready ruddy and sunburnt like most Brits do, by the way, please put suntan lotion on. Today is your day of the British summer, Karen.
The vitamin D injection.
It's our annual vitamin D injection today.
Well, our producer Britt described it as a false spring the other day. So
it
this
says she of
false
Canada,
summer
which is
today.
dark most of the year.
So we have false summer today.
Well, no, it was gorgeous in the park yesterday. I didn't see you, by the way. I was running through. But it was just beautiful yesterday. But today
I was hiding from you. Has he gone
Well,
yet?
last time I saw you, you were away with the fairies. Well, thinking about life, and I was like, Karen! And you had no idea I was screaming at
This
you.
is my natural state of play. Post-show.
Well, back at me, yes. SoftBank, meanwhile, is set to acquire chip startup Ampere in a deal worth $6.5 billion. Carlyle Group and Oracle have committed to selling their stakes in the company, which will operate as an independent subsidiary. The deal is expected to close in the second half of the year. Well, Lynn joins us with plenty more. Lynn, lovely to see you.
Yeah, hey Steve, and a bit of a reversal because it is looking wonderful in London, but we're actually getting sort of all-day rain here in Singapore. But back to the topic at hand here. So this is, what we've been seeing from Masayoshi Son. He has been for quite some time now talking about doubling down in terms of AI. That's where he sees the future, artificial general and super intelligence. And we're seeing sort of more of that deeper investment coming here. So it seems like this is all about sort of creating synergies and that self-reliance. As you say, $6.5 billion all cash deal here. And for ARM, it does seem like, this is where it's positioning right at the center here, because it could potentially make ARM a little bit more of a complete player, because at the moment, of course, its bread and butter is making the licensing, the chip designs that go into smartphones, tablets, and other things as well. But we know that Ampere makes the server chips using ARM's design. So there is that synergy there. As we know, of course, there's been such a push in terms of building out the data centers, the AI infrastructure. Stateside, we had that announcement in terms of Stargate, that up to $500 billion investment over the next 4 years. And we also heard the news that Nvidia XAI joining the likes of BlackRock as well in order to develop AI infrastructure stateside as well, guys.
Let me ask you, Lynn, about where Ampere sits in the market, because it feels like it was really up against the odds against the big players anyway with its technology. Others are already crowding into the space using ARM architecture, but now it's going to be a stablemate to ARM. So where does it sit in the race as we talk about AI?
It seems to be that, Ampere is really kind of focused in terms of chips for data centers, right? And so that is really all about the AI infrastructure. And so you can see that from SoftBank's perspective, as of course they embark on this Stargate project with some of their partners here, that this is front and center here. And as you say, very crowded space now, very, very competitive space. But also, as part of this deal, of course, 1,000 or so chip engineers as well that are hired by Ampere, joining that broader complex here in an area where, that sort of talent at the moment is super competitive as well.
Lynn, thank you very much for bringing that to us. And part of me wonders whether this is Masayoshi Son's way to try and make sure he makes money in the Stargate build-out, that he's got a piece of the pie through an acquisition of a company, so it's in the stable as well. Because it did look like SoftBank could be competing against itself if it was out there as the major fundraiser for Stargate. How is it going to do that? Well, it's also raising funds and conducting its own business. But I think this is
he doesn't mind getting in further on the journey than others, does he? I mean, he's got some investments which have been phenomenal, of course, but are being made at latter stages of funding rather than the early stages, if I can put it that politely.
Because he was behind the curve when it came to investing in AI, and now you've got a 6.5 billion purchase.
Yeah, some of these investments seem to be done at multiples which are quite eye-watering.
Well, to be fair, the multiples get there after a couple of months. You can start up a company if you've got any expertise, and then suddenly it's got a billion price tag on it after a couple of months.
Yeah, which is one multiple, but that's the valuation. But in terms of the earnings multiple, they seem to take a little bit longer in many cases.
That's right. Let's get to the rest of the big news flow from the sector. Nvidia CEO Jensen Huang said the firm is set to spend hundreds of billions of dollars on chips and other tech manufactured in the United States over the next 4 years, as threats from the Trump administration's tariff blitz increase global uncertainty. Huang discussed tariffs with Mad Money's Jim Cramer.
We're enthusiastic about building in America as anybody. And so we've been working with TSMC to get them ready for manufacturing chips here in the United States. We also have great partners like Foxconn and Wistron who are working with us to bring manufacturing onshore. So long-term, manufacturing onshore is going to be something very, very possible to do, and we'll do it incredibly.
But the Chinese are still a key partner right now. You have a lot of business. So I would say 17% of your business.
Yeah, in the near term, I would say in the near term, tariffs will not, the impact will not be meaningful, and.
But AI diffusion, that last initiative by Biden, which said really there are only 18 friendly countries that we want you to do massive business with, that seemed arbitrary, if not judgmental, in a way that I think you and I would say it makes no sense.
As you know, as you just look around here, there are companies from all over the world. AI's gone mainstream. Okay. AI isn't some magical technology. It's incredible technology.
Elon Musk, xAI and Nvidia are set to join Microsoft, BlackRock and MGX in their venture to build $30 billion worth of data centers and AI infrastructure. The AI infrastructure partnership aims to secure up to $100 billion in total investment. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.